When someone talks about peer-to-peer investing, what they really mean is this. Everyday people like you and me can now lend money directly to other individuals through online platforms and earn interest on those loans, often at much higher rates than traditional savings accounts. This idea took off after the financial crisis, when banks pulled back from lending and technology made it possible to match borrowers and lenders online. Today in Europe, peer-to-peer lending is a well-established part of alternative investing. To understand how this works, imagine you are acting like a small-scale bank. Instead of depositing your money with a bank, you lend it directly to borrowers through a platform that handles everything: credit checks, loan origination, and payment. That's the core idea behind peer-to-peer or P2P investing. You provide the capital, borrowers receive the money they need, and you get interest payments in return. The reason many investors are attracted to P2P is the potential for higher returns than most bank products. Depending on the borrower's risk profile and the platform's structure, returns on P2P loans can range from the high single digits to low double digits annually. However, with higher returns come risks, primarily the risk that a borrower may stop repaying. Let's briefly look at how some well-known European peer-to-peer platforms operate and what kind of interest rates investors typically see. Starting with Lend in Switzerland. Lend focuses mainly on consumer loans to private individuals. Investors earn interest that usually ranges between 4% and 8% per year, depending on borrower credit quality. Loan maturities are typically 12 to 60 months, and investors receive monthly repayments of principal and interest. The platform offers auto-invest tools to spread money across many loans. In the Netherlands, Geldvoordelkaar is one of the largest and oldest peer-to-peer platforms. It finances both private borrowers and small businesses. Interest rates usually range from 6% to 12% depending on risk class. Loan terms are commonly 1 to 5 years, and investors can choose between manual selection or automated investing. Moving to Italy, Prestimoci focuses exclusively on consumer loans. Investors typically earn around 5% to 9% per year, with loan maturities ranging from 12 to 60 months. The platform emphasizes borrower credit scoring and steady long-term cash flow, rather than very high yields. In the UK, HNW lending mainly targets secured or asset-backed private loans, including property-linked lending. Because of the added security, interest rates are often in the 7% to 10% range, with maturities varying from 1 to several years, depending on the structure of each deal. In Lithuania, Finbi offers unsecured personal loans. Since these loans carry higher credit risk, interest rates are usually higher, often between 8% and 15% per year. Loan maturities are typically 1 to 5 years, and the platform provides auto-invest tools to help investors diversify across many borrowers. Finally, Mazzino operates in several European markets and focuses on transparent consumer lending. Investors usually see interest rates in the 4% to 8% range, with loan terms of 12 to 60 months. Mazzino places strong emphasis on risk classification and automated portfolio building. Across all of these platforms, be it Lend, Geldvoordelkaar, Prestimoci, HNW Lending, Finbi, or Mazzino, the economic logic is the same. You provide capital. The platform pools or allocates that capital across borrowers. Borrowers repay with interest over time, giving you a return. What differs between platforms is how they manage selection and risk. Some allow you to pick individual loans manually, giving you fine-grained control. But this can be time-consuming and may concentrate risk if not diversified. Others offer auto-invest tools that automatically spread your investment across hundreds of diversified loans based on rules you set, which helps smooth returns and reduce the impact of individual defaults. Most platforms also use credit scoring models and risk categories. These models aim to estimate how likely a borrower is to repay based on income, credit history, employment, and other data. Higher risk borrowers usually come with higher rates and therefore potentially higher returns, but also higher probability of delayed payments or defaults. Then there's loan maturity. Personal loans in peer-to-peer platforms typically range from 1 to 5 years, with monthly or quarterly repayments. Because these are real loans with real repayment schedules, your cash flow, the interest and principal returned, tends to be more predictable than many other alternative investments. But that predictability only holds if loans are repaid on time. And that leads to the biggest risk in peer-to-peer lending: credit risk, the risk that a borrower won't repay. When someone stops paying, your return can shrink or disappear. That's why diversification is essential. Investing small amounts across many loan parts dramatically reduces the impact of a few missed payments. Finally, there's platform risk, the risk that a platform may fail operationally or financially. Even if borrowers pay, problems at the platform level can delay your access to funds or complicate collections. That's why platform transparency, regulatory compliance, and financial health matter just as much as returns. In summary, peer-to-peer investing in private loans gives retail investors the chance to act like lenders, earn above average interest, and directly finance real borrowers. It's one of the most accessible forms of alternative finance because you can start with modest amounts, access historical performance data, and automate your strategy. Platforms like Lend, Finbi, and Mazzino each illustrate a version of this model, from unsecured personal credit to secured or asset-backed lending, and each has its own approach to risk, automation, and investor tools. If you want to learn more about how to evaluate loan credit quality, build diversified portfolios, or use automation tools effectively, make sure to follow and subscribe to CrowdInform, where we help you navigate alternative investing with clarity and confidence.